have to say I am deeply honored to be here today. And the reason, actually two reasons for that. The first one is to have a case study of EDP renewables done by FEP School of Economics and Management, which I thank you very much. It's the first case study about EDPR. The second reason is I am the CFO. My name is Teixeira. I'm the CFO of the EDP Renewables. And right now I have in front of me my planning and control teams. And what I'm about to tell you is what just a brief overview of what has been the strategy of the company so far and what have been some of the question marks raised from the last meetings I had with investors. Which means that you will have over the next 40 hours to work on the strategy of EDPR so that we can discuss it back on Friday. Now, so what the good part of it is that you will have 40 hours to do that because in reality, if I was asking you to do this at EDPR, you would have 24 hours. So it's very good that you have those 40 hours. About EDPR, and let me see. No? Okay, great, thank you. Thank you very much. So what was EDPR? And this is a brief overview of what was EDPR, which you may know already as planning and control teams of EDPR. Okay. This was EDPR back in 2005. It was a company that was primarily in two countries, Portugal and Spain, driven by the fact that we were kind of a business unit within the incumbent of the utility in Portugal. And basically it was a company that had 418 megawatts of installed capacity in Iberian Peninsula. This is EDPR as of first half of 2013. It's a company that has more than 8,100 megawatts, is present in 11 countries and has two main platforms, one in Europe and the other one in the United States, and a small presence in Brazil, not Latin America, effectively in Brazil. I mean, this is a story of growth. EDPR had a 24% compound annual growth rate over the last years in terms of production, generation of electricity, and we currently hold the third position in the world. We are the third largest wind company in the world. The first is actually a Spanish company, Iberdrola. The second one is a US-only company, Nextera, and we are the third one. Now, this growth has been achieved through a very solid execution of the projects that we have under development or that we may have acquired in development stage, but effectively was driven by the fact that we have very strong engineering and construction capabilities, and this has been what drove these 5.1 gigas of additional capacity over the last 5.5 years. I have to say also that it's also fair to say actually that this growth was achieved because the sector was in a growth mode. So if you go back in time, you will see that at some point in time, 2006, 2007, renewables was actually kind of a sexy business and was primarily driven by European jurisdictions and the United States. But the fact that we have most of our growth in our core countries was the basis to achieve a large capacity, I would say a large installed capacity, a large installed base, and this was enabling us to have a different positioning whenever we would be entering into new markets, because we would then have the reputation that we actually can deliver the growth prospects that we believe we typically aim for. Now, just a few financials. The growth in capacity has to be reflected in economics and the cash flow. Otherwise, there would be a question mark to what extent growth is creating value. And from EBITDA perspective, I mean, if you're just showing the last 2 years, there has been a very healthy growth, both at overall as well as on a per unit, per installed basis. 12% growth between 10 and 11 and 17% growth between 11 and 12. But also this has to be reflected on the cash flow. Once the assets are deployed, this is a capital-intensive business. It's a 25-year return period, so we really need to have those assets generating cash, and also operating cash flows have been growing by more than 13% in 10 to 11, and then about 4% 11 to 12. Now, the core of this company, what are the strategic pillars of EDPR? I tend to say they are, we have to keep a very simple mindset about the strategy of a company. To define a plan, you need 3 points. It's basic mathematics. And the 3 pillars of the strategy are, the first one, quality assets. We need to have our asset base, the 8.1 thousand megawatts that we have installed. We need to have it fully operational. We need to have it generating the cash flow that was foreseen initially when we decided to proceed with the investment. The second one is about pursuing selective growth opportunities. The world is full of countries or markets where growth potential exists. We need to be very selective in what type of countries or markets we want to aim for. And thirdly, we want to make sure that we have a business model that is self-funding. And the reason for that is that the previous business plan, which we presented to the market in 2012, were very much driven also, in part it was driven by the fact that we would have to meet the largest shareholder, EDP, balance sheet restrictions. And with that in mind, we had to prepare a business plan that would have to accommodate growth and as well repaying debt to EDP. But if we look beyond that, the business model of a growth company has to be self-sustainable, and therefore we need to be sure that we pursue that growth through a self-funding business model. So let me just address each of these topics in a bit more detail. When we look to the asset base of EDPR, it's a very young asset base. Our assets, on average, have about 4 years old. They are about 4 years old, which means that we still have 21 years ahead of us to generate the cash flow that we aim until we get the returns that were foreseen by the time we decided to invest. Which means that, in one hand, it's good to have a young asset base because it means that we still have a lot of value to be captured in front of us. But the other means that, on the other hand, it means that we really need to keep up and make sure that these assets do generate and do operate for the next 21 years. And I think it's also relevant to highlight a couple of differentiating factors of EDPR when we look to this operating capacity. Imagine that you install a hydro plant in a place where there is no rain and there is no water. It doesn't make a lot of sense. The same with wind. We need to make sure that we install wind farms in places where there are wind. But not only that, it's not about being good. We need to be the best. And to be the best means that we need to have better load factors than anyone else. And the reason for that is if you are in markets where you're price takers, it means that you get a premium over the market. If you are in markets where you are price makers, it means that you can actually get a competitive advantage vis-a-vis the competition. And to be able to maintain this differentiating capacity or capability in the wind assessment, in the wind, it means that we need to have in-house resources of how to measure wind and how to estimate long-term wind forecasts. And we have been doing so. You can see on the right-hand side on the top that on average we have been achieving a premium load factor. This is just an example for Spain. But this is driven by what we believe to be core capabilities of EDPR, as well as, of course, having our engineering in-house to make sure that then we design the wind farm so that we can build it at the lowest cost possible. And ultimately, we entail this with the procurement strategy, so to ensure that we have the lowest cost of sourcing for the turbine, particularly for the turbine, but as well for the what we call balance of plant, which is BOP, is the construction of the wind farm. But a point I'm trying to make is that the fact that we have this differentiating factor or capability means that if we are able to maintain so, we will naturally be driven higher or a premium vis-a-vis the competition. Sorry, I want to do it too fast. This one. Sorry, this one. Secondly, in order to maintain a low risk profile for EDPR, we need to be sure that the way we sell the energy, the way we sell the output of the wind farms, and bear in mind that we sell two things. We sell energy and we sell a green attribute, the fact that we are producing energy with no CO2 emissions. we need to ensure that we minimize the risk profile of that revenue stream. And to minimize the risk profile of that revenue stream, we basically have either an option to sell under a feed-in tariff, something which is defined by a government, or we have the option to sell it through a power purchase agreement, a PPA, which is effectively a long-term contract, 15 to 20 years contract to sell electricity at a predetermined price. If you look to what is the current breakdown of EDPR's source of revenues, you will see that we have been achieving our goal of maintaining at least around 90% of our sales under this low risk profile or long-term fixed price mechanisms, and with a long maturity. Actually, more than 80% or nearly actually 88% are maturing post 2020. So this again gives visibility that over the 21 years of the asset lifetime, we know pretty much what's going to be the realized price, and this is critical so that we will be comfortable to invest in any particular asset. And also a breakdown in terms of what is the risk profile of these long-term contracts, because you may have counterparty risk, you may have regulatory risk. In terms of risk profile, it's pretty much split between this power purchase agreement, the PPAs, or long-term hedges, and feed-in tariffs. Again, pretty much are the two main sources of revenues for EDPR in the different jurisdictions. Thirdly, O&M. The wind farms to operate need wind, but actually before wind, they need to be available to operate. So if I have a wind farm which has any type of problems that you can imagine, and if it's not available, it will not operate when the wind blows. On average, we have been achieving higher than 97% availability at the wind farms. That means that over 365 days of the year, every single turbine on average is more than 90% of the time available, which means that whenever the wind will blow, we will be able to capture the wind. But also, we need to make sure that we have under control our operational and maintenance costs. Again, if we have a fixed top line, we need to ensure that we have a good control of the OPEX line. And to do so, we have developed, as you well know, a proprietary O&M strategy model. And this has allowed, over the last few years, to have significant decreases in the cost per megawatt installed, either between 15 to 20%, depending on how we address the different contracts. And again, this is absolutely key to ensure that we don't also get exposed or completely vulnerable to the manufacturers, to the turbine manufacturers, and that we have also under control our own O&M strategy. The alternative would be very easy. We just hand over everything to the turbine manufacturer, they give us a guarantee, basically an insurance, and we wouldn't care about anything. But they would charge us for a premium. And that would mean that we would not be able to have these costs under control. So this is the third and very important component or driver of making sure that the operational assets do perform as expected. And I think, yeah. Now, let's talk a little bit about, and just a recap of what was the 2012-15 growth business plan. One thing we need to bear in mind, because nowadays one of the main, or at the time also, one of the issues that we will have and we will face more and more is a question about to what extent wind is a competitive technology or not. Okay? And what we have been showing, for many years already, at least for 2 years, is that on a levelized cost basis, so if we look to the 25 years cost of a technology, including cost of capital, cost of running, dismantling costs, wind is one of the most competitive technologies. And this was naturally driven by the fact that the efficiency of the equipment has improved, the cost curve of the sector has went down, and therefore wind is currently a competitive technology. And I think this should be always in the back of our mind, because it's very hard to think about large-scale growth for a technology which is already a mature technology if it is not competitive. Now, with this in mind, we believe that these are currently the markets where wind is likely to have growth potential in the future, either short-term or medium-term. You will see that the dark areas are countries that have already achieved more than 2 gigas between 2005 and up to 2010. The orange and red areas are the markets where we believe they will have a significant growth within the time frame of 2015 and 2020. Naturally, the risk profile of these areas are completely different, but this is where we believe growth will be driven. And again, one of the main reasons being not the fact that these countries have to comply with any renewable targets, some of them have, but mostly because in some of these countries, the wind capacity or the natural resource wind is actually strong enough to justify having wind as an alternative technology within the energy matrix. So we thought about how to develop the EDPR's business plan back in May 2012 until 2015, supported, I would say, in three different pillars in what concerns growth. One is naturally to look at the core geographies that we have and see what is the potential for growth in those core geographies. We should never underestimate the fact that we have strong presence, and typically we may be number 1 to number 3 in some of the core markets where we are. Secondly, would be to tap new markets. And again, one too fast. One would be, secondly, to tap new markets, and new markets that where we see that we should have, in one hand, economic growth or demand for new installed capacity will be needed in a specific time frame. Secondly, that wind makes sense because wind is a natural resource. And thirdly, wind can be wind makes sense because it's a natural resource and can be a competitive technology. And thirdly, has, I would say, a reasonable risk profile. So bearing in mind these three criteria, we have been looking into tapping into new markets. And thirdly, new technologies. The 8.1 gigas or 8,100 megawatts that we currently have installed are pure wind, with the exception of 60 megawatts of solar photovoltaic, solar PV in Romania. We need to think about what if we would grow into other technologies, namely solar PV, other types of solar technologies, or even wind offshore, where we currently have already a project under development phase in the UK offshore. I haven't got this right yet. And the point is that whatever we choose, or whatever we decided in terms of growth, we always need to bear in mind that there is a balanced portfolio that has to be kept. And the value of having this balanced portfolio is actually, to some extent shown when we look to this page. In this page, we have the main geographies of the current operating assets of EDPR. And we will see that in different geographies, we have been facing challenges, either market-driven challenges or regulatory-driven challenges, and with different outcomes. But at the end of the day, the fact of having a portfolio has enabled EDPR to still maintain a solid, not only asset, when we look to the asset base, but a solid growth prospect. Again, Spain is challenging regulatory on a retroactive, with retroactive application, still in progress. Portugal, there was a discussion with the Portuguese government about changing regulation. There was, a negotiated outcome. Poland is still, there is a new law that may be presented and published, but this has 18-month history, so we never know when it will happen. US, there was a kind of a black hole, let's put it this way, by the end of 2012 about what would be the growth potential of the US because of regulatory changes or extension of tax credits. All of a sudden, US became a very important market for growth. So the fact of having a balanced and diversified portfolio is effectively a driver of value. And this is why also when there has been a sort of a shift in terms of what we thought would be the main contribution for growth back in May 2012, and then within the first few months as of 2013, we shifted that way of thinking. So while I would say 1.5 years ago, we were thinking that most of the growth would actually be driven by European jurisdictions, namely Eastern European countries, with a lower contribution from the United States. Right now, we actually believe that for the short term, let's say short to medium term, US will be the main contributor for that growth, and we will scale down the growth from Europe and primarily Eastern European Union. And again, why? Because in the US, with that tax credit extension, utilities, which are our clients, reacted. They decided that it would be a good time to lock in long-term contracts. And of course, it was a commercial opportunity for EDPR that we have been quite successful in capturing that commercial opportunity. Finally, self-funding business model. As I said, I mean, we need to be mindful that this is a growth company, but it's also a company that has a significant amount of cash flow being generated, around, give or take, 700 million and growing. So we need to be, it's not that we are not a startup. So we need to make sure that we have a model, a financing model, that is an enabler of the growth potential of the company. When we think about near-term growth should be funded primarily by three different sources. The first one, and which is the natural one, is the cash flow from operations. On an accumulated basis, we believe that over 4 years, this company should generate something like 3.1 to 3.8 billion euros. Let me step to the last and leave the middle to the end. Project finance and tax equity. I mean, tax equity is a very particular financial instrument in the United States to allow EDPR to capture those tax benefits. That with some project finance in some specific geographies, primarily where we don't want to take FX risk, we will generate something like 1 billion, perhaps a bit more than 1 billion euros. And the one in the middle is also a key component of this self-funding business model, which is asset rotation. And the big number is 2 billion to be generated in asset rotation. Now, the point about asset rotation conceptually is actually, rather simple. We believe that we are good in the late stage development of the wind farms. We believe that we are good in the construction and procurement of the wind farms. And we believe that we are very good in the operation of the wind farms. However, when we do this, we are actually de-risking. So through this process, we are de-risking the project, the asset, from a development stage to an operational phase. When we de-risk, we reduce the cost of capital of that project. However, we recognize that EDPR, as of today, is not the only natural owner of these assets, because likely there are entities and agents out there that have a lower cost of capital than EDPR. And if this is correct, then it means that we should sell down our assets. Not 100%, not the majority stake. We want to control the assets. We want to make sure that we can deploy the knowledge about operating assets, but we can sell down minority stakes. And this is the very basic rationale of asset rotation, to sell down up to 49%, and with the proceeds that we get from that sale, reinvest into new growth. So going back to the first part of the chart, and reinvest into late development and construction assets. And of course, by doing so, if we can actually sell this to someone that has a lower cost of capital than EDPR, we are actually crystallizing value that we would not be able to capture if we were on a standalone basis. We have done already 4 of these transactions. Again, execution matters. One thing is about having a fantastic, beautiful PowerPoint with strategy. Execution matters. We have already closed 4 of these deals, not 3 as the title says, but 4 of these deals. 2 with Canadian infrastructure funds, where it does make sense that the fact that they do have access to lower cost of capital than EDPR has. 1 with China Three Gorges, which is, as you know, it's the largest private shareholder of EDP, our main shareholder, and has established a framework agreement with EDP through which they will be investing in EDPR's wind farms as minority holders. And 1 last one with Axpo. It's a Swiss utility, mainly with nuclear assets in Switzerland and also hydro. and they are diversifying their portfolio, and they bought just recently 49% of some of the wind farms that we have in France. So again, this is a demonstration. It's execution of what we have been thinking through as self-funding business model, but primarily through the asset rotation. And when we go back to May 2012, the cash flow that we thought, that we plan to have available, so we'll need cash flow to, going to the left, from left to the right. We will generate something like 3.1 to 3.8 billion of operating cash flow. There will be some either CDG or divestments that would account for approximately 2 billion. Of course, we will have some project finance and some cash and equivalents, so more than 1.5 billion all in all. Where we will use that money for? We will use it for growth, for capex. We would use it for repay debt and others. And we were expecting to have something like 1.6 to 2.3 billion of cash available by the end of 2015. And what we would do with that money? Primarily, that money would be to repay debt to EDP. So if you recall my earlier point, when we designed this plan, it was a plan that was foreseeing to have significant amount of cash available to assist EDP, the main shareholder of EDPR, to reduce its debt. So what are the challenges ahead? I mean, that was it was a long time ago. It was May 2012. We are already in November 2013. Not only the world changed, as the challenges have changed as well. I think it's fair to say that the way we see this, we are in the right side of the equation. I mean, there is always a debate about being renewable or going to fossil fuel. I think that either because of volatility in the commodity prices, either because of the fact that if a country bets in fossil fuels, it will be dependable either on natural resources or will be dependable upon other countries which have demonstrated to be higher risk than initially thought for example, North of Africa, which means that there is a question mark that has to be solved about security of supply, and also some of these technologies we understand that are environmentally dangerous. On the renewable side, the fact that the technology evolved so much, it's much more predictable than what it used to be in terms of what we expect to produce over the lifetime of the wind farm, and even in shorter periods of time. It's an endogenous resource. Wind is here and will be here no matter what. It's harmless to the extent that we don't have risks. There are no main hazards at the wind farms. And it's, of course, a CO2-free generation. So when we look to this picture, we say, yes, we are on the right side of the equation. And this should be recognized also by different governments and different agents when thinking about this technology as part of the energy matrix. But there are significant challenges ahead. And the fact that, to some extent, you can see some schizophrenia around. Because on the left-hand side, you see that there is still a global economic crisis, showing signs of recovery, but it's not where we would like to be. And this means that lower demand means lower consumption of energy, and lower consumption of energy means that energy markets have gone down in terms of pricing. I'm not talking about oil, I'm talking about electricity markets. We have sovereign debt crisis. This means that cost of funding just gets higher, primarily if you're based in south of Europe. But in some other countries, cost of funding has gone up. Shale gas in the US, this is a completely new paradigm for the US over the last 2 years. It's a reality, it's structural. Gas prices in US will be structurally low for decades unless there is a change in how how the US thinks about being an island or not for gas in terms of gas. But that means that the fact that they have significant amount of reserves of shale gas, they will not be importing shale gas, and means that gas prices will be structurally low in the US. Just give, I will not give you any references. And of course, we have setbacks in regulation. Different countries are driven by economic crisis, public pressure, politicians have been challenging the existing regulatory frameworks applying for the existing wind farms or existing assets, not only wind farms. And this is effectively, one of the main challenges that we currently have, again, for the operating asset base. But on the other side of the equation, we still have government supporting mid to long-term objectives, and again, either objectives driven by the will to be green, or objectives driven by the fact that it makes sense to have these technologies as part of the energy matrix. More and more, these technologies have been improving, and it's not about wind; it's also about solar. We have seen significant improvement either on the efficient side, also on the cost side, and therefore this supports a view of additional growth through these different renewable technologies. In the US particularly, there was this extension of the tax benefits program that was providing visibility to the different utilities and different players in the sector that reacted very quickly to that. And finally, in something which we understand can be a very good solution on a long term, which is there are some countries that are more and more relying on ex-ante competition. So instead of defining feed-in tariffs on an administrative base, they actually rely on setting up competitive processes through which the one that achieves the lowest price wins a contract for the next 20 years. It doesn't eliminate regulatory risk, but it does mitigate regulatory risk because it was the result, the outcome of a competitive process. So with this in mind, I think that we have here a couple of questions to answer to our investors. And this is what I'm going to ask you as our planning and control team to think through over the next 40 hours, which is, well, first of all, is there value in growth? I mean, what growth, if any, should EDPR aim for? And bear in mind that we are looking at a bit longer time frame than the 2015 business plan. Secondly, if we are to grow, in which markets would it make sense? Bearing in mind, our strategy, our risk profile, the potential of the markets, organizational threats, whatever. With which technologies? Should we keep a focus on wind onshore, or should we actually, look to other different technologies as the source of future growth for EDPR? Alone or with partners? It's always a question, which may be a different answer depending on the market as well, or the technology. Can we actually deploy our capabilities, what we believe that we know to do better than others, and it's difficult to replicate by anyone, by the competitors? Can we actually deploy those capabilities and differentiate ourselves vis-a-vis our competitors? And if so, how can we actually achieve and ensure that we'll be successful in those markets, the new ones, naturally? And how can we actually combine this asset rotation program with the growth opportunities? There always can always be a mismatch in terms of timing when we execute one vis-a-vis the other, but are those compatible, and how can we do so? So these are just, I would say, the main questions which I set up as the challenge, and open for one question per table, right? Yes. Thank you.